It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the CFPs on the program. With me in the KFG studios, no Kevin Korhorn today, but along my side is Josh Gregory, CFP, and one of the business partners I have at KFG.
Yeah, glad to be with you, Mike.
Yeah.
Well, what's the best way to invest money that you'll need in just a couple years? This current investment world that we're in has created a dilemma on deciding, do you go for safety of principal or do you actually try to get a rate of return with some of this safer, shorter money? And we're going to share our perspective and answer questions from fans of the show in this hour of Wise Money.
Yeah, the hope here is this hour we're going to be tackling a whole bunch of questions, a big variety. We're starting with a question from Chris, fan of the show. If you have a question, love to hear from you. You can call or text us 574-222-2000. That's 574-222-2000. Online, you can submit questions there as well. Search the Wise Money Show. Actually, wisemoneyshow.com. It's right there. And then all over social media, many questions come on the YouTube channel, sometimes on Facebook, whatever. But search the Wise Money Show and follow us there. All right, so the headliner topic, like I mentioned, is a question from fan of the show, Chris. We appreciate the question. He submitted it on the website, went to wisemoneyshow.com, submitted it right there. Here's what he said. Is there a short-term investment you recommend for half of a house settlement through a divorce? Need time to decide what the future holds. Great. Yeah, great question. So we'll answer this question directly, but I think many people are finding themselves in a similar scenario, not with the divorce piece, but listen, I've got some money. I don't need it now. I might need it soon. Mm-hmm. What do I do?
Yeah. Well, and just the fact that Chris is choosing to pause long enough to just say, you know what, I don't want to race into any financial decisions. A lot of times, if it's after some like major life transition, you just want to kind of take control back and make some action so that you can feel like, okay, I'm in the driver's seat in my life at a time when maybe it hasn't felt like that recently. And to just pause and give yourself some time to kind of gather your perspective a little bit, understand the lay of the land now in this new world, I think is really wise. That could be after losing a spouse. It could be after a divorce, as Chris has said, or some other major change. Maybe you lost a job. And you need to have resources, and you don't yet know what the game plan is. That is a time where you're kind of in limbo, but hopefully not passively in limbo, not just waiting for things to happen, but actively trying to begin to adjust your plans and everything. During an environment like that, when you have money that is short-term in nature, and I would define that as money that might need to get used inside of a year or two, even 3 years.
Yep.
The key is to not like suddenly put all that money at risk or tie it up and make it illiquid for you. Right now, at a stage in life where you're trying to pick your next path, flexibility, having options is the key. And so right out of the gate, the first thing that we would be talking about is just what's going to give you flexibility on liquidity. What are you going to be able to access when you need to? What's going to not get yourself painted into a corner? So any product that or financial tool that's locking you in for some set period of time that doesn't match your time frame, I think could be a risk.
Yeah. So Josh and so all the shows are organic. Like there's nothing scripted here. And so Josh was rambling about whatever, and he could tell that I wasn't really paying
buying
attention.
you time to like get your head screwed on straight.
Thank
My
you.
goodness.
Really appreciated that. I was looking for a chart here because I can explain this chart really well over the radio. No, I won't be able to. But why are more people than just Chris facing this sort of struggle? And there's always the temptation to say, well, I've got some money, I don't need it now. Can I invest it and get some quick return? But I feel like the circumstances make this an even more dangerous and tricky choice right now. simply because, and I'm looking at a chart that goes back to 1994, okay? And it shows the amount of interest that you need to beat inflation and the average interest rate on a savings account. And there is a marked difference once all the QE started, once the quantitative easing, once the stimulus started. And I'm not talking about from the pandemic, I'm talking about 2008. Up until that time, mid-90s, all the way till 2008, you were earning enough interest to at least meet inflation, and most years double it up. Yeah. And since 2008, we're not even close. And right now, guys, I'm looking at the chart. On a $100,000 savings account, you need to be earning $4,000 a year to beat inflation, and you currently are earning about $70.
Is that crazy or what?
So if you're not talking, I mean, if you don't look at this and say, hey, Chris, I feel you, man, I feel you, then you're just not looking at these numbers, because we all are tempted to say, gosh, I got this money sitting here. What do I do with it, right? And so now another chart, and this is earlier in my slide deck that I'm looking at. I'm not going to be able to get there, Josh, unless you want to buy me some time. Is a few measures of where the stock market is on a relative basis, whether it's expensive or cheap. Okay, and Josh, you know this chart as the forward PE ratio, and we're at second highest levels ever. In fact, if you then say, okay, well, at these levels, where does history say the stock market, the performance will be over the next 12 months? It's totally random. But what does history say where the stock market performance will be on average per year over 5 years? Based on history. I'm not saying this is, everything is very different right now. It is very weird. We've never had this much money printed and blah, 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 okay? I haven't dealt with the pandemic in, a century, right? So it's very different. But based on a historical perspective, we shouldn't be surprised if the stock market is back to where it is right now, 5 years from now. We shouldn't be surprised. If
you
5
said
years from
back
now,
to where it is.
Well, yeah, okay. So if
implying that it falls and then recovers in that time period.
So that's a Freudian slip, I think, is what they call that,
Or goes
Josh.
flat.
Could go flat.
Or goes higher and then comes back down.
Exactly, right. So we shouldn't be surprised if that's what happens, okay? So there again, I think if you don't need money now, but you're going to need it soon, this is a very tricky time because you're going to get clobbered with inflation. You're not going to be able to keep up with it, with it just sitting in the bank. And you would argue it's an extremely risky time in the stock market because of these elevated valuations.
And yet that is, unfortunately, the decision that a lot of people are making, right? That, I'm not making anything if the cash sits there in the bank account. You are being punished for being a saver right now because of inflation. Life's getting more expensive. Everything's going up in cost while your dollars just sit there idle, barely earning anything that's noticeable. $70 a year on $100,000.
That's right.
Let that sink in just a little bit.
Yeah.
As opposed to back in 1994, so that's what, 27 years ago, something like that. It could have been $4,000. And so times are not the same as they once were. And so what it's doing is it's luring a lot of people into taking more risk, buying into what has felt like the only game in town for a long time, and that is the stock market, whether it's buying mutual funds, buying individual stocks, or there's even a whole new generation that's starting to dabble in options trading
we got a question we're going to be hitting in just a second. I want to take this question though a little bit further. I mean, so Josh, I'm just going to give you a clue what I'm thinking. What are the top 3 things you'd consider on short money? What are the top 3 things that you'd consider? And then, so what flexibility should you have? What are the thoughts, considerations? So we're going to dive into all that and then hit additional questions from fans of the show. So we got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Right now, this is our 1-hour weekly talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday. Also on podcasts, same time. and then a few radio stations in northern Indiana. That's why it's an hour. That's why we've got to stick to a certain schedule. If you don't like that schedule, check out the content that we drop every business day, Next Wise Step videos, taking a financial concept, Roth conversions, IRMA, blah, 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 right? Some stimulus changes, some tax proposals. We're applying it directly to your financial life. We've got that content every business day. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. And if you like the content, leave questions as well. Thank you. Okay.
I'm eager to hear what your 3 would be.
I didn't even write them down.
Yeah.
They're just swimming in the ether. So
who knows what will come out then.
Yeah, that's true. That's true. So, all right. Let's see. My guess is Josh is going to say, I'm just going to say this for the record. Here's my guess. I don't know what he's going to say. I can look at his notes, but
Well, as soon as you utter it, you guarantee I'm not going to. But go for it.
Bitcoin. Double leveraged Bitcoin. and Dogecoin. Short-term money. I'm just kidding.
You weren't specific enough because it's double leverage Bitcoin with a home equity line.
Oh, that's right. And margin.
I mean,
somehow.
Yeah.
All right. Okay. That's what you should do with your short-term money.
I'm more of a stock guy, so I've got a few stock picks for you.
All right. He's joking. No, I'm not. So, all right. Here we go. What do you do with short-term money these days? You know, you're getting clobbered with the inflation. You're earning no interest. Stock market's been running up. What do? You don't need the money right now. You'll need it in a couple of years. What do you do? We're going to share our top 3 ideas with you right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Joshua Gregory. Every episode of the Wise Money Show is on the YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show, and subscribe to it there. Lots of content that we drop all throughout the week, not just these full 1-hour talk shows. Lots of content all throughout the week, so go check it out. All right, so still tackling Chris's question about, hey, I've got some short-term money. I don't need it right now, but I might need it in a couple of years. What should I do? Talking about why this is such an interesting and challenging question right now, but, you know, brass tacks, Josh, let's get to it. Like, so what do you do? I'm just going to qualify this, just the full disclaimer. This is not advice, and the best idea comes in the context of your overall financial plan, because maybe the best idea is for you to pay down debt. Maybe the best idea is for you to increase your 401k contribution so you're maxing them out and then you live on some of this money. Maybe the best idea for you is to fund Roth IRAs because you can pull that money back out. You can pull your basis back out, blah, blah, blah. There's all sorts of ideas when you look at this from a comprehensive financial planning perspective.
And you know that's how we want you to be thinking of it, right?
Yeah.
That this is not a decision on, hey, give me a tip on what's the best bank account out there that will pay me 0.05 instead of 0.04%. That would be awesome.
Yeah.
Please, I'm waiting. No, the safe money that you need to hold in preservation, its main purpose is to still be there when you need it a year from now or 2 years from now. Now, if you are really keyed up on inflation right now, you would argue, well, if I put it in the bank, it's not going to be there when I need it because it's eroding every single day, and that is the dilemma right now. Yep. And if you let the inflation tail wag the dog too much, what you would be almost forcing yourself into is saying, I have to go earn a better rate of return than inflation. Otherwise, I'm losing ground, and I don't want that. But recognize that anything above cash, anything above a savings account or a really short-term CD or even a treasury bill, anything above that is bringing new risk as you invest it.
I mean, right? So the number one idea is to find the highest interest FDIC insured account that you can. I mean, that is still the best idea. Now, that's not the one that's going to get a bunch of ratings on the radio or on YouTube podcast. But listen, that's still, you've got to look at this in the context of your overall financial life and your comprehensive financial plan. But likely that's the number one idea. And for us, you typically find that there's 3 rules when it comes to these emergency funds or the short-term money. It's got to be FDIC insured. Okay. It's got to be free don't pay someone to hold your money, especially when you're getting nothing in rate of return. And it's got to be liquid, okay? And so that typically, and then after that, give me the highest interest rate out there that you can find. And I still use Capital One Bank. There's Marcus from Goldman Sachs that's gaining a lot of attention. And so, but they're paying what, like 0.5%? I mean, point nothing.
It's right. It's not even worth mentioning. And like you said, it's not even enough to keep up with the inflation.
Yep.
So every dollar that's sitting in the bank account, just recognize and know this. The value of it, the spending power of it is moving away from you. It's declining, in other words, as time goes on because of inflation. I like, though, one of the things that you had shared about financial planning, more unorthodox approaches to putting this money to use in a way that is financially productive to you, something that's going to give you some kind of an economic gain. And it could be paying down some debt. But if you pay down debt, that does not meet the description usually of staying liquid and not tying up the money, right? Because if you pay down some money on your house, the only way to get that money back out of the house is to sell the house, or borrow it back against a home equity line or something like that. But that might be a strategy in an environment like this. If you've built up some equity in your home, and you have the ability to put a home equity line in place, maybe you already have one. Maybe you're already carrying a balance on that home equity line. The beauty of paying down a home equity line is that as you pay it down, you could always borrow it back if you need to, at least until the term is up, the period of time that allows you to go utilize the credit limits and everything. But by at least not carrying a balance or carrying a smaller balance, you're saving yourself that amount of interest. And a lot of people have a home equity line that's charging them 4.5% right now.
Yeah.
So if you could go earn 4.5% by essentially saving that interest, no longer sending it off to a bank, that's as good as a rate of return essentially. And that's getting closer to maybe keeping up with some of the core inflation that's happening right now.
And if you can also, and again, you've got to evaluate this in the context of your comprehensive financial plan, but if you can also save some taxes, that's a way of getting a return on this money as well. So to me, if I'm just gonna share them with you, I mean, number one, you've got to consider an online money market account, like I already talked about. I mean, that's number one.
Or savings account,
or
either
savings
one.
Account, yeah. Number two is if you want to go up the risk ladder just a little bit, you could consider a short-term bond index or short-term bond mutual fund. You might be able to earn 2%. Now, it's not going to have that guarantee with it, but
it can fluctuate in value in the short term.
But and boy, we've got the Fed tapering right now. The last time they did that, there was a taper tantrum, and interest rates took us, skyrocketed within a couple of months. So it's risky with that. But you step onto the risk, you step off the risk-free platform, you go onto risky, and you might be able to earn a little bit more return. You're not taking a wild amount of risk. And then the third idea, though, and this would really depend on how likely is it that you're going to need the money in these next few years, is if you say, well, I could go up the risk level a little bit more to try to get a little bit more return. There's some hedged or buffered exchange-traded funds that you might want to maybe consider, but they're very complicated. Those are the three ideas I would share.
And I mean, there's other ideas as well that if you're willing to go study, you're willing to put in some serious learning and maybe even have a more active role involved. That might be one of them if you can research some of those kind of special tools like the exchange-traded funds that are coming out. There have been times in the past where we've utilized a strategy to purchase callable municipal bonds.
Yep.
That one is one that is... That's like moving up the food chain on complexity and workload involved, right?
Yeah.
And you have to take into consideration the value of your time. Because if you spend a whole bunch of time and energy and it's taking you away from the life you're trying to live just so you can eke out a little tiny bit better rate of return, you got to ask yourself, boy, is this worth it?
Yep.
Or am I actually better going and building skills that are marketable out there that I can actually turn into additional income for the family. That sort of thing.
Does the size of the account, does the amount of money matter? Should that influence what options you consider? If someone other than Chris, Chris didn't even tell us how much money he's talking about here, but does the amount of money matter?
I feel like it could. I mean, there are some folks who will open up accounts directly with the Treasury and purchase T-bills, essentially.
Yeah.
Sometimes, depends on what's happening with interest rates from day to day, week to week. Sometimes you can get a little bit better rate of return that way. But again, to do all that work, it probably needs to be a sizable enough pool of money to justify.
We're definitely going to be talking about I-bonds coming up, inflation-protected bonds. I mean, not on this episode, but coming up soon, either on a Next Wise Step video on the YouTube channel or interviews or whatever on the radio, and certainly for a discussion for an upcoming Wise Money show, because those are interest protected in a way, and the interest that they're paying, the real interest it's actually there, as opposed to negative, which is what most interest-bearing accounts are receiving. So we've got additional questions from fans of the show. A lot we're going to get into, that and more coming up on the Wise Money Show with Korhorn Financial Group. All right.
That's segment 1 or 2? That was 2, right?
2. It's only been one time that we've just continued to ramble.
Well, and it was the two of us who pulled that off.
It sure was. I certainly would have.
Lindsay, you need to supervise a little more
said
closely.
For sure, if that was going to happen, Kevin Korhorn would have been involved in some way. But nope, that was us, brainiacs. All right, so Stock Boy, and then
I thought for sure you would list Tesla stock. I don't know how that doesn't make your list of emergency fund holdings.
Let's do Stock Boy, and then we'll go up to Fred, and then maybe hit Aaron. Would be this is the third segment. Mm-hmm. Yeah.
Okay. So. Hang on here. Who'd you say, Fred?
We'll start with Stock Boy, then Fred.
Oh, yeah. Stock Boy.
All right. What are the income limits when funding or trying to fund a Roth IRA? And there are income limits on both sides. We're going to talk about those right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, no Kevin Korhorn today, but along next to me is Joshua Gregory. If you have any questions for the show, we'd love to hear from you. Stay up to date on Wise Money content. Submit questions online, wisemoneyshow.com, and then all over social media. Wherever you're at, we are there as well. Search the Wise Money Show. All right, transitioning next question here from the YouTube channel. I have a question, ? Thank you. If I lost my job.
What is happening?
I don't know. If I lost my job and have no earned income for this year, but I've been trading stocks and stock options and I've made money, capital gains, can I contribute to a Roth IRA?
Boy, that story is becoming more and more common, isn't it?
I mean,
there's entire YouTube channels on how to trade.
YouTube was created for that, for the most part. Like, that's exactly. Yes.
I thought it was to show you how to unclog your drains.
Well, yeah, that too.
That's what I'll be YouTubing tonight, actually. In case you're wondering.
Sorry, kids. Dad had to rush off to work. All right, here we go. So, what are the income limits? What are the income limits with funding a Roth IRA? So, does capital gains, does that qualify you to contribute to a Roth? That's a simple question.
Well, so I was going to frame it as what type of income allows you to even be eligible. And because you kind of answered the question here, I have no earned income, and earned income is the magic phrase when you're trying to decide, can you fund an IRA or a Roth IRA or really any type of retirement account. And earned income it's like paycheck money. So do you have a job where you are going to receive a W-2 at the end of the year? You're working for a paycheck every week or two or whatever. Or it could be maybe you have a side hustle, not trading stocks though, or trading options, a side hustle that results in self-employment. So if you You would know this if this applies to you because you would be filing something called a Schedule C, which is basically where you record all the revenues you collected, subtract all the expenses, and what's your profit from this side business that you're doing. Well, that profit is treated as earned income in most circumstances. Unfortunately, when you're trading stocks, unless it, I don't know, maybe if it was like your actual job or something. Some people will flip houses and it can be passive. Other times it's earned income. But the point here, though, is most likely you're not going to be eligible to contribute to a Roth IRA. If you already have money in a traditional IRA, though, maybe this is a year where you've got a little bit less income, you're in a lower tax bracket, and this could be a scenario where you actually seriously consider doing a Roth conversion, which is the second way that you can get money into a Roth. It's moving IRA dollars to a Roth, but you pay tax in between. The nice thing is you pay tax based on what's this year's tax bracket that you're in, and it's possible that this is one of those years where you happen to be in a lower bracket.
And you use the cash that you were thinking, well, I'm going to contribute this to the Roth, use that cash to pay the tax instead. And now you've moved, say, 10 grand from your IRA, and you've got 10 grand in your Roth, and you cover the taxes out of that cash you had. Technically, the contribution limit for the Roth IRA, and same with traditional IRA, but let's focus on the Roth. Okay, ignore the traditional, what I said. Your contribution limit is 100% of your earned income up to $6,000. Up to $6,000. And if you're experienced in life, meaning you're age 50 or older, you can do an extra $1,000. Okay, so but the limit is still 100% of what you make up to $6,000. Okay. Now, just because you baited me there, let's talk about the income limit on the other side. I've done some shows and had some discussions on the Roth contribution limits if you make too much money. Okay. If you're a single filer or file head of household, your adjusted gross income can't be above $125,000. If it is, you start losing the ability to contribute to the Roth. And then if your income is even more than that, you can't do it at all. Okay. If you're married, that income limit instead of 125 is around 198, where you start losing the ability to contribute the maximum amount, and then it goes away completely. So there's income limits on both sides. And I've done several videos recently and done some radio interviews about this because I've just had several instances come up where someone's just funding the Roth and they don't realize, oh, I was working and now I'm on unemployment and I just kept funding the Roth. Oh, yeah, can't do that. Oh, I was funding my Roth and all of a sudden we've gotten some promotions and spouse is working and got a bonus and my income's going to be higher this year. Yeah, you can't fund the Roth. So.
Unless it's in a year where you had already built up at least $6,000 of earnings earlier in the year, right? Yeah. So don't hear what Mike just said and said, hey, I just lost my job and now I can no longer contribute. Maybe you earned enough in the earlier months of the year to be able to still pull it off.
Yep. All right, great question. Appreciate that. All right, next question from Fred on the YouTube channel as well. Let's say I got a share of an inheritance of property. Let's say a check for around $100,000, and that puts my wife and I over the income related monthly adjustment amount.
Wow,
okay, so that's IRMA, and that is $176,000 of married filing jointly on your income tax. Would that increase my Medicare for just 1 year, or would it be for the rest of my life? I realize that you don't know all the particulars, but just roughly speaking.
Okay, so let's kind of unpack some things here and kind of level the playing field, because what Fred is referring to, we can discern a few things. Fred is at least age 65 because he's on Medicare. And what a lot of people don't realize until they're actually on Medicare is that you get Part A for free. You pay for Part B on a monthly basis. In 2021, it was $148-ish.
Yeah, okay? $148.50.
So that comes out of your Social Security check every single month. You're paying for that. And what a lot of people don't realize, though, is that if your income goes too high, they'll start charging you more.
For the same thing.
Same thing. It's not like you get a better policy. No, you're going to just pay more of the load, unfortunately. Mm-hmm. And it can move up in a hurry. And correctly, it's at about $176,000 of income that all of a sudden, I'll call it a penalty. You start getting penalized with higher premium amounts that you have to pay. The question is, well, what is it that causes you to get higher in your income? It is all of your different sources of income, but the way that this was framed was, okay, I received a check for $100,000. We don't know enough details to know, well, what was the nature of that inheritance before it got turned into a check? Maybe it was a financial product that had never been taxed in the prior owner's lifetime, and so now when it's being received, it's treated as income for Fred and his wife. We'll assume that he's right in that way. However, make sure that you've checked, right?
Yeah.
Make sure that you're really accurate and is that $100,000 actually going to be income?
Right, and so he says inheritance of property. Let's say a check for $100,000. How I would read that as inherited a house. The house was sold and it was divvied up, and I got a check for $100,000.
Yeah.
Is that taxable income, Josh?
It wouldn't be.
It wouldn't
be. In most circumstances. It depends on how the house was owned. There's always it depends. But this is why you need to be talking to the attorney that's helping to settle the estate, or if there's a CPA involved, they will be able to help you more definitively know, is this taxable or isn't it?
In just a minute, we're going to get to the part of the question where he says, okay, I'm above that limit, this IRMA, this income-related monthly adjustment amount limit. Do I now have to pay this penalty, as Josh eloquently put it, for the rest of my life, or is it just a year, or is there a way I could avoid the penalty altogether? So we've got that question and more coming up on the Wise Money Show with Korhorn Financial Group. Did I even give you a spot there?
No.
Okay, it's easy? So I don't need to worry about it? Can I just ramble on my long run-on sentence, and then occasionally you can just splice it in there? Okay. That is how I talk. There's no periods at all. Sometimes an exclamation point.
Do you even breathe
and
when
then
you
this
talk?
one, no. And then
It's
this one,
amazing.
see, I just did it right there. This one, I deleted it. But I have a question mark, which I'd never even noticed until I started reading that on the air. I don't want to, you know how some radio people and YouTubers, they're just rude. They're mean. Like Dave Ramsey.
And Mike Bernard?
So I don't want to be that guy or person. So, all right.
That's funny.
Um,
Hence your thank you.
yes.
Comment.
Thank you. Okay. Let's say 4 seconds. So land the
We're
plane.
going to finish answering that question
And then,
and then go to Aaron.
yeah, sure. If you want to tackle that one.
All right.
Haven't
Interesting topic. I don't know.
haven't even read it yet fully. So see what comes out of
And
my mouth.
Aaron is studying to be a CFP himself.
Love it.
That's exciting.
Love it.
In
Okay.
Ohio.
All right, here we go. Is there an exception if you cross over that limit and have to start paying a penalty or a higher amount for your Medicare tax? Is there an exception that you can file? There actually is. We're going to talk about it right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Josh Gregory. Every episode of the Wise Money Show is on podcast. Go check it out. If you listen to podcasts wherever you go, just search the Wise Money Show. Follow us or subscribe to us there, whatever, and rate the program. We appreciate that. Leave comments there. We appreciate that. All right, so we got a question here from Fred, and just to catch you up, he said, let's say I inherited some property, or I get a check for $100,000, and that puts my wife and I are above then that income-related monthly adjustment amount of $176,000 when it comes to Medicare Part B and Part D. So now we have to pay a surcharge or a penalty or an additional amount for our Medicare Part B and Part D. Will I have to pay that for the rest of my life, or is it just 1 year?
Yeah, the good news is no, this isn't necessarily going to cause you to jump in your price on Medicare Part B and D. It's just going to be a temporary one-time deal. And the reason is essentially what the government does is they look back a couple years at the tax return from 2 years ago to decide what your premium cost will be, your share is for this year. So in 2022, it'll be based on your 2020 tax return. Am I correct in that?
Yep.
And so if you have one particular year, maybe 2020 was some sort of an anomaly where you had this big spike in income or some major event, you might say, well, boy, I'm all of a sudden going to have to, pay this additional premium, and I just didn't see this coming. A lot of people don't even realize it. In fact, the way they find out is 2 years after the fact, they get their letter at the beginning of the year saying, here's what your Social Security is going to be this year, and oh, by the way, here's what your Medicare premiums will be, and it just, floors them. Well, what just happened here?
Yeah.
Well, we have to look back a couple years and see what was happening in your income. There is a way, though, to often appeal this number and try to get an exception. And it's essentially you saying, hey, this is not my new reality. This is not what life's going to look like moving forward. It was due to some major life-changing event, and I'm asking for this to be kind of brought back down to my normal level. Don't penalize me. I would certainly make the argument personally that receiving an inheritance just one time would be a type of event that you ought to be able to get appealed. Sometimes retirement and your income dropping significantly because you're walking away from a paycheck, that could be an event. Maybe you sold the family farm and it was just a one-time year where you're paying a bunch of taxes with a bunch of income. You can appeal that. Sometimes they'll grant you a reduction. Sometimes not. We've been successful at times helping clients with this. We've fallen short at times too.
I mean, for the exact same reason.
Right.
Like the
It
IRS,
makes no
there's
sense.
there's no consistency here. And I'm looking at the form. It's form SSA-44. That's not going to be on the quiz, but that's what the form is. It's Medicare income-related monthly adjustment amount dash life-changing event. And when you look at this, and they even tell you can fill out this form or you can give them the nice folks at the Social Security office a call and talk through this. I don't think that's going to get you very far personally, but type of life-changing event. I think each of these, they're basically they're trying to argue the opposite. Like, hey, your income was permanently high and now it's low. Tell us why. When in fact, most people use this form for, hey, my income's permanently low and it spiked high.
Right.
And so, yeah, these type of life-changing events aren't very helpful. So it's really going to be a coin toss as to whether they grant you this appeal or this exception. You still got to go through it, though. I would definitely.
Yeah, don't
definitely
just
do
skip
it.
the process, right?
Yeah. So, all right. Hope that helps. And, this income-related monthly adjustment amount, that is got to be part of your planning. That has to be, because your required minimum distribution impacts that. Your big withdrawal from an IRA to buy a car or to do a home improvement, that impacts that. So you just got to be very planful with it. So, all right. Next question comes from a fan of the show, Aaron, on the Facebook page. He says, and Aaron, I'm just going to apologize right now. You wrote this when it was warm out, and it's currently very cold out. So that's just how long this thing's been sitting on the shelf, but they all go into a queue, and so here we go. He said, hey, love watching you guys every week. I'm studying for my CFP, and the show has been very helpful in that perspective. That's fantastic, Aaron. Good luck. All right, so here's what he says. My wife and I want to start investing in real estate and mainly looking to own some rental properties. We have a goal of being financially free someday, but just so nervous at getting started. We keep hearing to try to not use any of our own money. So I guess we use a home equity line or the BRRR strategy, which Josh is going to walk us through in a second. Wondering if you guys could speak to these strategies. A little background on us. We both have decent jobs. We make about $130,000 a year. We have $80,000 in college debt. We have $20,000 in savings and investments, and around $30,000 in equity in our home. This is wise for us to do. We're still in the learning phase. I'm just going to commend you for that, Aaron. I mean,
Yeah.
A lot of times people, they're like, okay, well, is there really a full parachute in this backpack? I don't know. Let's go. Jump. and so you being careful to walk through this and think through it. Love that approach.
I agree. The fact, though, that you are in the learning phase, I think partially helps to answer the question, too. Because you want to match what's my skill level with the strategy, and also, am I in a position where I can afford to take this level of risk ultimately. Okay. And certainly, there are all kinds of YouTube videos out there that talk about the BRRRR method, BRRRR approach. This is a rental real estate approach. It basically, if you've never heard of this before, it's where you buy a house that needs to be fixed up and you rehab it. That's the first R. And then you rent it out. And after it's rented and it's collecting income, then you go refinance it to get your cash, any money that you've got in this deal, back out, kind of leverage it back up. And after that, then you basically go repeat.
Yeah.
Right? Keep doing it over and over until no one will lend you money anymore, right? Or until you can't find houses, or who knows. This is a tough environment, I would think. And I don't do this personally, so maybe there's all kinds of bargains out there that I'm just personally not seeing. But in this type of a housing market, can you, first of all, buy it right? That seems to be, part of the formula to doing well in real estate is you can't overpay for the real estate itself, especially not if you're going to maintain it for a long time and rent it out. This approach, though, it's different than flipping a house. With flipping a house, you'd buy it, you'd rehab it, and then you just sell it.
Yep.
Instead of refinancing it or renting it and then refinancing it and doing it all over again. So to me, I listen to this strategy. I've watched a lot of these videos, just want to understand what people are doing out there. And it feels to me like an aggressive borrowing approach. Like it's trying to use other people's money, OPM, right? And just recognize that when you use other people's money, you're inviting risk into your life, right? You're giving up control, which is the exact opposite of financial freedom, by the way. The more of other people's money that you are using to try to achieve financial freedom, the risk is that you get into some sort of a sideways scenario where life's not going like you had planned. Maybe those renters are not staying put where they belong, or they're trashing properties, or who knows? I mean, there's all kinds of horror stories with being a landlord at times. But if things don't go the way that they need to, do you have the financial resources to absorb the hits?
Yeah.
And it is awesome that you have $20,000 in savings and investments. That's great. You're building and everything, but that needs to be a larger dollar amount if you're going to suddenly have more properties where more things can start going wrong.
Yeah, that's my temptation too here, Aaron. And again, there's a lot we don't know all. You provide a great detail, and again, I love the idea, and we're big fans of rental real estate. And yet, I might suggest just looking at this, you want to get a little bit more ready. So a couple things that I'd throw at you, and if you're a fan of the Wise Money Show, maybe you've seen some of our content here, but to me, I've got my 4 laws of rental real estate, and that's not these 4 little, things to consider. No, like I've never seen successful rental real estate happen if you're violating one of these, okay? And the first one is you need some cash. And I'd agree with Josh. I'm not sure that the equity that you have and the cash you have is going to be sufficient based on the risk. Okay, but it's up to you, and I guess it depends how much house you're going to buy, how much rental you're going to buy. So you got to have some cash, got to have some time. Okay, you and your wife are making good money. I don't know what other extracurriculars or family or whatever you're chasing around. You got to have some time. You got to have some know-how. Otherwise, all your margin's going to go to someone trying to put bearings on your toilet or something. Like someone's going to take you for a ride and say, well, you need this gadget here. This is like what everyone does to code or whatever. And you're just going to get taken for a ride. If you can't do any of the work yourself, then you're going to give up your margin, and you're probably going to spend more than you ultimately should. And then the fourth one is that you need to be okay with confrontation. You're going to have okay, Mr. and Mrs. Renter, you got to pay for that stain. No, that blood stain was here when I moved in. No, it wasn't. That axe was in the wall. No, it wasn't, right? Hey, if I pay you rent, I'm not going to be able to buy Christmas presents for the kids. You got to be tough a little bit.
That's right.
And so I would tell you that. And then the other thing, this is the other sort of philosophy that I've taken with rentals, and that is, yes, you've got to assume that this thing is going to be rented and occupied, but your financial life needs to be the safety net. You shouldn't get into a rental that you can't put 20% down on and that you can't afford to make the payment on, the monthly payment, or cover the repairs if there's a renter if it's vacant. Your financial life needs to be able to withstand, and so you've got to budget that out to see.
That's exactly right. And I think what we're kind of hinting at here is not only all those fantastic questions and laws, as Mike said, on whether or not you should even be a landlord, but are you in that stage right now of truly building wealth? Is that the name of the game right now, or is this still laying the right foundation?
Yeah.
You start building too soon and you don't have a strong enough, deep enough foundation in your financial life, you may bring too much risk or too many assets, and it actually can cause your life to start to crumble financially. And so I'd want to see you getting aggressive on the student loans, getting those wiped out, and making sure that you have the right resources for those down payments and the greater emergency fund if you choose to go become a landlord.
Fantastic question, though. I hope this helps you, the perspective helps you as you're pursuing financial freedom, financial peace, and certainly as you're pursuing a career as a CFP. That's fantastic. We love the idea of rental real estate. I mean, really do. It's just the prices of houses have gone up faster than I think rents have gone up. And that's eroding what your potential return is. So anyway, that's all the time we have for today. On behalf of Josh Gregory and myself, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.